Welcome to the Uncertainty Edge. I'm your host, Sam Sivarajan. Today, I'm joined by Jeff Panik, founder of Balanced Wealth Partners and a financial advisor with nearly 26 years of experience helping clients navigate the complex intersection of financial obligations and genuine life fulfillment. Jeff's journey is deeply personal. As the first in his family to attend college, he enlisted in the U.S. Army to pay off student loans, an experience that revealed his own lack of financial literacy and ultimately shaped his career mission. From his military service in Korea to building an independent practice in Atlanta, Jeff has made it his mission to fill the financial education gap that so many young adults and families face today. He's the author of books focused on financial literacy for young adults and pre-retirees, offering practical, jargon-free guidance in areas where far too many people are left to figure it out alone. Whether you're an advisor looking to better serve clients across generations or a leader navigating your own financial decisions, Jeff's insights on mentorship, realistic expectations, and intentional living offer clarity in an increasingly uncertain economic landscape. Jeff, welcome to the show.
Thanks so much for having me today, Sam.
Pleasure. Jeff, as we talked about in the intro, you were the first in your family to attend college. You graduated, as so many of us do, with student loans, and then you enlisted in the U.S. Army to help pay them off. It's an experience that ultimately led you into financial planning. Can you walk us through that journey and the moment when you realized financial literacy was going to become your life's work?
Yes, certainly. I grew up really without, I would say, a roadmap for money. Really didn't have a mentor or accountability. If you're in an environment where you're trying to get by day to day, it was just my mother and myself. It was more of a week to week type of thing, from the standpoint of money. We weren't thinking about retirement. It's like thinking about getting by. And I
Hmm.
was lucky enough where I had certain opportunities through her hard work that really allowed me to go to college. Really, the challenge I found with college really was just direction. It was the first time I was really away from home. Really had never really traveled. Didn't really knew very little.
Hmm.
And I grew up in southwestern Pennsylvania in kind of the coal area. And so, I went to Duquesne, which is in the city of Pittsburgh, and there was a lot to do and a lot of distractions for me. And I wasn't quite prepared. I was prepared to have fun, but not so much for the education portion.
Right.
And, about 6 months before I was getting ready to graduate, I received a letter from Sally Mae. I had no idea who Sally Mae even was. I thought it was like a magazine subscription or service or something. And they're a loan servicer, and it said I owed $1,000 a month for the next 10 years. I had no idea what I wanted to do. And I was really kind of in a pretty bad spot because I couldn't go to anyone and ask for help because no one had resources to do that in my family. And so, I decided to go in the military and the army. They had a program for your service that they had a loan repayment program where it deferred your loans and then they paid them off in full. So it worked for me. It was, I like to say I learned probably about 10 times as much in the military than I did at college.
Hmm.
Part of the reason why I didn't learn that much in college, I really didn't take it seriously. In the military, you have to take it seriously. It's not an option. So it
Right.
was more, kind of a trial by fire. And really, when I was in the military, I found a lot of people that were like me, really, that were just trying to figure out, basic financial skills that no one really taught or we really learned.
Hmm.
And it's really a matter of really difficulty because of just the way the system is set up.
Yeah. And I think when we chatted before, that situation hasn't really changed much, right? I mean, whether in the US or in Canada, I mean, this idea of teaching financial literacy in high school, for example, there are lots of courses that are mandatory across all programs, whether it's languages or maths or sciences, even, potentially advanced math or science. But, I like calculus in high school, don't get me wrong, but I think I use personal finance skills on a daily basis far more than I ever did calculus. And I'm surprised that, this isn't becoming more of a push.
And it's really, I mean, I view it as almost like a crisis, and there's not as much motivation I think on the legislative side, because of the lobbyists that are with the credit card companies and this, you can start adding up the groups that are involved in terms of loading young adults up with debt and putting them in bad positions. And you end up in a situation where, no one's really teaching consumer finance. It's more, if you take a finance class in high school, if you're lucky enough, a lot of it's probably more economics and things that,
Right.
really aren't really what they need to learn is how, how do you write a check if you have to, how do you open a bank account? How do you get the most out of your money? And how don't you make a lot of mistakes that a lot of young adults do because they just don't know any better? And, I'm extremely sympathetic because that's kind of the background that I came
Right.
from.
Right.
And it's only, I think, in some ways gotten worse because of just the amount of leverage and just the amount of information that's out there. And, if you turn on a football game, you'll probably see every other ad is a financial company trying to sell something.
Well, we'll come on to this in a minute with the buy now, pay later, like the whole point of sale. It's become a whole different landscape. But you just said something that is actually intrigued me because it's a perspective I hadn't actually thought of before. That the resistance to kind of providing this kind of literacy curricula, for example, in high school, that you attribute some of that, at least that resistance to coming from lobbying from, financial firms, et cetera. That's an interesting perspective. I hadn't thought about it that way, but it sort of makes sense, right? It's against their interests to have an educated consumer out there that understands compound, has a better understanding of compound interest, et cetera.
Yeah, and I mean, if you go to a college library as an example, you'll find no shortage of credit card offers and people willing to lend you money to get you in kind of the door, as opposed to really resources to try to help you kind of navigate and really build a financial foundation, as opposed to being in a bad position before you even start kind of what I would call the race of life.
You've written books, as I mentioned earlier, targeting specifically young adults and pre retirees, two very different life stages with distinct financial challenges. What patterns do you see in terms of the financial literacy gaps at both ends of this spectrum? And why did you choose to focus on these two groups?
Yeah, so I think really both are really at decision processes. Obviously young adults are starting out. They have to figure everything out usually on, I would say, on demand. When things happen, whether their car breaks down and they have to figure out how they're going to pay for a new tire, or they have to get a completely new car or a used car, how do you even do that? And then you have the retirees who I view, it's almost like when you live somewhere for 25, 30, 40 years, when you go to move, almost like it's a puzzle scavenger hunt to try to figure out, and you can't even believe how many things you have.
Right.
And so really pre-retirees, it's really a matter of trying to put pieces together of a big puzzle that's specifically their own. And with young adults, it's a matter of getting the information out there so they can really learn and build a strong financial foundation. And that's the problem. If you don't do certain things, like, if you're a young adult and you stay on your parents' plan, you go off at 26 because you have to, and you just say, well, I'll just get around to getting the healthcare coverage, and you have an accident, and then you end up having all this debt. And, it's that way a lot of times, even for pre-retirees, when they take on Medicare, if they don't get the right coverage, they could find a tremendous amount of costs down the road that could be really, really prohibitive to what their view or what their thought of retirement was going to be.
Now, there's all sorts of challenges for all consumers, but particularly for those two groups in getting the right information and understanding the right information. I want to talk to you about two different aspects of that, perhaps. So let's talk about, for example, the buy now, pay later programs, high interest credit cards, and the ease with which young people can quickly accumulate debt without fully understanding the consequences. They're marketed to constantly, like it's February, you want a vacation, you can buy it on credit. I think there are, whether it's in the investment world or whether it's in the lending world or whether it's in the banking world, I think there is some push towards disclosure, right?
Mm.
That you have to disclose the rate that you're borrowing at. You have to disclose, what that is going to impact. Yet that doesn't seem to be solving the problem. So I'd like your perspective on both of those. So how do you deal with this fact that you're being constantly marketed to, particularly if you're in the early 20s and you don't have a mentor or a family member to help you navigate these decisions? And is how do we solve the fact that disclosure doesn't seem to solve this problem?
Yeah, I mean, you get into the disclosures. I mean, I use the example of the student loans. You could sit there all day and probably read the disclosures, but most of the kids don't even know what they're even reading. And what's really even the point of the disclosures in the first place? That's the problem with that side, looking at student loans and a lot of the other debt. On the pay, the pay buy now, pay later, really it's an issue where really you have to take a step back from it. And sometimes the easier people make things, it doesn't always mean it's the best decision for you to move forward. And, really, I always say there's really three questions anytime you're looking to purchase anything other than, like, say, a cup of coffee or a dinner, is really you need to ask yourself, do I really need this? What will it truly cost me? And how long will I be paying for it? And if you really ask yourself those three questions and it still makes sense to move forward, then move forward. But I look at it, you really want to make this easy process maybe a slower process. I would argue for smaller purchases, say under $100, you really use a 24-hour rule where you really wait 24 hours. And then if it still makes sense to move forward, you move forward with it. For larger purchases, I would call it almost like a 30-day cooling off period where because reality of it is there's all kinds of things out there, and if you take a few days, you may find a better offer, a better product that really achieves the same thing that you were looking for in the one that you were just going to jump.
No, I love that. I think that both those cooling off periods is very smart advice. And I think the idea of those three questions to ask yourself is very smart advice. How do you deal, or what advice would you give young people that are in living in a social media world where I would call there's a curated feed coming in? The highlight reels of all of these influences, other people showing off the good life, if it will, and not the blooper reel, which you and I understand that it is a very cherry picked view of life, etc. But in the moment, for a young person, when they're seeing this or when they think all of their friends are doing this, how should they think about foregoing pleasure today because it is the smarter financial decision?
I mean, I think the first thing to understand what the influencer, the person that you're viewing, what their objective is. Oftentimes they're getting paid by clicks. They're also in a position often where it's curated and it's usually like airbrushed, if you will, where
Right.
you're seeing the very best of everything and not what the reality is. And, really, I always say if somebody says something is perfect, you probably want to run from it because there's always going to be advantages and disadvantages. And so, usually, even if you're looking at reviews online, you really want to understand what the person's objective is giving the review. If they're a sponsor, they're pushing the product. It's certainly best to look in a different direction for a outlet that gives an objective review on something you're looking to move forward.
I think that's great advice. I think in general, I mean, especially in a world that we're worried about disinformation, etc. I think a good advice that you're giving is simply look at the source of that information and perhaps ask, what do they stand to gain from pushing their point of view or their perspective, right? And it's sad that we have to do this, but I think that it has become a clickbait economy, an attention focused economy. I think there are a lot of young people that are paying the consequences.
There's no question about it because it's sometimes, as you mentioned, they make it so easy, make it sound so perfect. And when you start on, it's like anything else. It's an onion. The more layers there are, the more chances there are of it being.
Now, in our pre conversation, Jeff, you described young adults today as standing at the starting line of a marathon and often comparing themselves to others already at mile 7. And that's a very powerful image. For advisors working with younger clients or parents that are trying to help their kids, what are the most critical early decisions that can either set someone up for success or dig a hole that they can't later climb out of?
Yeah, so I mean, I really think, the biggest thing that I see really not having a mentor, accountability partner, someone that is a little bit more savvy that can try to help throughout the process and help you learn just some of the basic skills. If the education system, if you haven't gone through a financial literacy program, if you can find someone that's trustworthy that can help you, it can really help you avoid this decision. And I use the example life financially, emotionally is really like a marathon. There's ups and downs. Just when you think you got to the flat section or the downhill section, you hit another hill.
Right.
And if you run you understand. I mean, it is the reality of kind of anything that is a long, you're going to have tough times. And really, the challenge I see for a lot of people starting out, they have no idea what direction to even run in. So, they're standing there while other people that have used resources and have family and mentors can really help really build a foundation and avoid a lot of the mistakes that see often, the high interest debt,
Hmm.
not having an emergency fund, and really looking at capturing funds and taking advantage of opportunities, whether it's an employer match, whether it's your employer, putting money in HS, doing things for you that will benefit you in the long run. But you want to take advantage and have resources. The last thing you want is to have an issue and you blow a tire. You have to get a new transmission, as an example, and you don't have the emergency money there and you have to borrow. Because typically, if it's going to be out of the blue last minute, it's probably going to be a high interest purchase,
Right.
and then you end up, in some cases, if you make the minimum payments, you end up paying 2 or 3 times what the original amount even was.
Now, to say something slightly controversial at this stage, but I think that, what do you say to young people who would argue that things are far more prohibitively expensive today than perhaps, 30 years ago, whether that's inflation, rent, affording to buy a house
Mhm.
or medical insurance for that matter? And that, wages, for instance, haven't kept up. So in that kind of a scenario, how is a young person to avoid making some of those types of decisions that, as you say, dig a hole that they can't climb out of, like getting into debt that isn't smart debt, etc.? It's, in theory, we can say that, okay, this is good debt and bad debt. In practice, when you're living hand to mouth or trying to make ends meet, which seems harder these days, etc. What is some practical things that young people can do or think about?
Yes, I think the first thing would be you wanna live within your means, and you don't wanna lock in high fixed obligations, like a high car payment where you're paying rather than living with a roommate, you decide to get a two-bedroom yourself. You have a bunch of subscriptions, in this case, not magazine subscriptions, but
Right.
streaming subscriptions
Right.
that you won't use. Really, the earlier that you start focusing on saving, the more that you can have money for the goals that really like the home ownership and home formation. That's one of the hardest goals that used to be taken for granted years ago. And unfortunately, with the way the policies are, they made home ownership even more scarce,
Hmm.
especially with people that are coming out of college with student loan debt because they just don't have the resources to be able to even put money aside for a down payment. So, really, the better that you can educate yourself and make decisions, and really, I like to use the 30-day rule, really take a step back, read or go online and watch videos, but watch a bunch of different ones that give different perspectives and find the one that you feel most comfortable with and it is the most reliable. You can make an informed decision. And unfortunately, in a lot of cases, you people stretch and it may be okay on one thing, but if your income doesn't keep up with inflation, which is really no one really if you talked about inflation, 4 or 5 years ago, no one would even know what you were
Right.
talking about.
Right. Exactly.
Now, everyone understands, whether it's the pre-retirees, retirees, and even the young adults, in terms of home formation, in terms of the cost of healthcare, and just, being able to afford things that, like a vacation that people would typically take for granted.
That's very powerful. And if I can encapsulate or, extrapolate a little bit of what you said, I think to your point, it's be informed, live within your means and start small. Yeah, I like that example of subscriptions, for example. We all get caught up in this, right? And I think saving on reducing one streaming service or rotating between streaming services that might save you $20 a month or $25 a month. And that doesn't seem like a lot, but if you keep doing it, that frees up a lot of room. That's $300 a year. And it just compounds after the other. And I think it's like any other habit. I think that's great advice that you're giving, that starting that savings habit or that budgeting habit, even if it looks small and even if it looks like it's not going to make a huge impact, everybody started that way. And that's how you kind of get that snowball going to get to bigger savings and then investments, etc.
Exactly. And I mean, I think what you really want to do, I mean, the power of technology now is you can automate and it makes it very easy to move money from institutions, high yields, moving it from your checking or operating account that you are paid in over to a high yield savings account. It's not like it used to be where you'd have to write a check, move the money, do all kinds of
Right.
things. And so really, and the other thing that I always say, sometimes people say, I'm going to wait till I have, enough where I can put 3 or 400 away a month or, and I say, well, if you can do 25 and you start with that and you work your way up as you get raises and time goes by, that's going to compound over time. And, the younger you are, the more time you have and the more opportunity you have to grow wealth over time.
Well, I mean, as a financial advisor, I mean, and it comes back to financial literacy, the power of compounding, which Einstein called the eighth wonder of the world. But I think beyond that, I think to add to your point, it's the habit that you get into, right? I mean, the habit of saving $5, $10, $25 a month. If you do it consistently enough, it becomes part of the habit. Yeah, you start to learn to live within your means. I've always said that that's probably the simplest way of budgeting is just take your monthly paycheck and take whatever, $25, whatever you can afford, $25, $50, $100, and move it into your savings account. And pretty soon you won't even miss it. So you're actually learning to live. If you were making $500 a week and you put $25 aside, you're learning to live on 475, right?
Yeah, and it's really a matter of just doing it. I always suggest doing it on a one-page sheet that's easy to track, where you see your income, you see your expenses, so you review them every, say, other week, just to make sure there's nothing that pops up that's out of the blue that you forgot about,
Hmm.
or you have a subscription renewal. That happens a lot when you sign up for something.
Right.
It's free for 6 months and then they get you,
Right.
or however long. You just wanna make sure you catch those, and if you're not using it, shut it off, because if it's automated, it also has the reverse effect with the expenses. If it's automated and you're getting the expenses, it's gonna keep hitting you until you shut it off and take that action.
And you talked about, Jeff, the importance of having mentors and accountability partners, and wholeheartedly agree. You made the point that, especially for young people who don't have built in financial guidance at home or at work, as an advisor, how do you step into that role, either for your younger clients or for the kids of your clients?
Mhm.
And what do you tell them about the mindset shifts that they will need to make in order to build financial resilience over time?
Yeah, I think the first thing is, as easy it's easier for me to say than it's easier said than done, is really to take the emotion out of it,
Right.
because money is governed by emotion and psychology, really. I think the financial advisory business and dealing with clients is more behavioral finance, psychological finance, understanding different personalities respond differently to different ways of communicating, and it's important to learn that very early on, because if you can try to work within the person's comfort level emotionally, you can get a lot further with them than if you're just talking. I call it almost like, at some point, a lot of people, you start throwing out all these terms: diversification,
Right.
rebalancing,
It goes over their head,
correlation.
right? The
Yeah.
eyes glaze over.
Yeah. And it becomes like a financial fog. And what ends up happening is the people just freeze up and do nothing, which is
Mm,
oftentimes the worst thing that you're doing, whether not saving or whether not paying down debt. It's really a matter of take some action. It's like the famous quote, perfect is the enemy of great, really, as it relates to action with your finances. And procrastination is also probably, I would call it almost like the devil, because the more you procrastinate, the harder it is, the longer it's going to take you to finish or complete what you wanted because you're not even starting it.
And to add to that, you're digging yourself into a deeper hole, probably
Yes.
with debt or lack of savings, right? So it's you have a big hole to climb out of when you stop procrastinating.
Yes.
Jeff, now let's switch over to the other side of the spectrum. So on the pre-retirement side, you describe approaching retirement as assembling a puzzle where none of the pieces seem to fit together. I assume that you're talking about the financial and the non-financial aspects of retiring, but I'd love you to talk about it.
Yeah.
What
So
are the most common, sorry, what are the most common misalignments you see when people approach this transition?
really, I think the biggest misalignment is thinking that you can just plan over a weekend or over a month or two. Really, this is something you just spend a year to 2 years planning out, and you need to have a focus. And the book on for career retirees, I have what I call a financial life inventory plan.
Hmm.
Really, it's a matter of gathering all the information and working through to come up and complete a plan specific for you and your family. And I think oftentimes people are so focused on what their coworker is doing, what a relative is doing, that they really do what that other person is doing as opposed to doing what is in their own best interest, which completely different. And that's really, where I look at pre-retirees, really, I would say probably out about 10 out of 10, their situations are all different. They have different, whether they're married, what their family situation is, if they still have dependent children, whether they're still working, whether they're going to work in retirement, whether they have pensions. There's so many variables, debt, and really each couple or family or individual, they have to work through it on their own. And it's important also to have an advisor that can work with them
Hmm.
or have someone that would be their accountability partner that will hold them to a timeline so they just don't procrastinate. And really it's a matter of, if you have 3 to 5 years before retirement, well, if you have a bunch of high interest credit cards and your kids are finished with college, maybe it's a good idea now to start tackling that. And if you haven't taken advantage of your employer match through your employer, probably a good time to do that. And really get informed about Medicare. You don't have to understand everything, but you have to really want to understand what the resources are, so you can make informed decisions so that you can actually, some people, people always talk about sleeping at night and all these other things. Oftentimes you can sleep, but what ends up happening is you get into retirement and you have something that happens like a 2008, or you have something where you have a medical issue that you weren't expecting, and you end up completely going 180 degrees from where you thought you were going. And so, I always say with any plan, you always want to test for the worst and you want to hope for the best. And if you plan the right way, you can accomplish what you're looking to try to accomplish.
I think that 2008 is a great example, and we can get into sequence risk and everything else. But I think the reality of it is, as you point out, is that you can prepare for everything. And if the market goes down, the market goes down. And so the idea is, I suspect, from your perspective as an advisor, you're not saying we're going to anticipate everything that is coming down the road. We know that markets go up and down. We know that politics and geopolitics are going to have an impact. You can't anticipate everything, but you're trying to build a portfolio and, I guess, a plan that has, to some extent, shock absorbers that is going to allow the retiree to be able to manage that. But at the same point, I guess you're working with that retiree in that point to say, okay, we have a foundation that is going to allow us to be able to respond smartly and calmly and rationally to whatever transpires. Like, we will have to make changes probably to your plan, but we're not doing it out of panic. We're doing it from a good foundation and some smart planning that has already gone to.
Yes, and I think that's really the main component or point. And I think if you get into if someone is very detailed, that's good, and you can get really into the granular details of everything. But most people want to know where you're getting the information from and that they're going to be okay. You have to have an honest conversation. If they're not, you need to tell them and what they can do to try to fix it. Whether it's, you can't spend what you thought you were going to spend. You need to adjust your income. You
Right.
need to maybe work a little bit longer if you can, give them options. The other side that I think people sometimes on the reverse side, they focus so much financially, they forget about the other side of it. It's really, you've worked your entire life in most cases and you're retiring. What are you going to do? And so one of the chapters in my pre-retiree book just talks about, what do you do? Do you volunteer? Do you work part-time? Do you spend more time with your family? Do you focus on your health? A lot of these things, what you want to do is you want to test those out before you retire. And, I use the example of if you maybe haven't taken care of yourself the way that you should because you're focused on your family and work, maybe, a few years before you are set to retire, you really get a thorough health exam, you
Mhm.
really have an honest conversation with a physician in your family and make certain changes. And if you need to get things taken care of while you're on your employer plan that is usually typically going to cover more, that's a good time to do it as opposed to getting into retirement and realizing, you have all these issues with your, whether it's dental. I see that a lot where, people have to spend thousands and thousands of dollars on dental and they don't really have the right coverage. And so, I think and I use the other side of it, couple, you want to make sure if one wants to move to the beach and the other wants to stay put, you have to have a conversation about that. And the sooner that you do, the less you can really take away a lot of a lot of friction from a couple oftentimes that really haven't with work, family, all of a sudden they're retired and they have to spend a lot of time together. So
Right.
it's a
Right.
matter of making sure both of them are on the same page with what they're getting themselves into with retirement.
It's a very important point. I think in previous generations, we hadn't had this freedom and opportunity and the longevity to an extent. And I think it's most people don't think about retirement other than what you get from the commercials, right? So what are you going to do in retirement? Well, of course, I'm going to go, I like golfing every weekend. So now I'm going to golf 5 days a week. I like traveling once a year or twice a year. Well, now I'm going to travel all the time. And the reality is for most people, after 6 months of golfing every day, if your body still allows you to do it without having injuries, you're probably sick and tired of it. So and you've spent plus years working 40 plus hours at a job. And as much as you might not have liked it, I think most people forget that was your social network, that was your purpose. So in my mind, the idea of saying on a Friday night that, I'm retired, on Monday morning, you wake up and you're going to be riding off into the sunset happily ever after, I think is the greatest disservice that anybody can do for their preparing for their retirement. Because it is, we prepare for every chapter of our life, whether that is going to students, going off to college, whether it's getting married, whether it's buying a house. I mean, but we don't seem to spend enough time. I'm overgeneralizing here, but we don't spend enough time thinking about, as you say, 2, 3, 4, 5 years before retirement, not just the financial elements, but the non-financial elements. How's your health? I think that's a great point. What can you optimize at this stage from your current health coverage, et cetera? But also, like, what do you want to do? Where do you want to do it? Are you? I liked your point. Are you and your spouse actually going to be able to spend all of that time together? Without getting on each other's nerves. But these are conversations and discussions and plans that should probably be visited sooner rather than later, and certainly not wait till after retirement to do it.
Yeah, and it's, the one thing that I often see is it's a situation where they say they'll get around to it and they'll say, well, I want to retire at a specific age, and they don't really get around to really looking at anything. And then what ends up happening is invariably they have a health issue, the company downsizes, and then they're really scrambling. And so, even if you don't think you're going to retire in the next 3 or 4 years, you may say, I want to work another, 10 years or 12 years or 15, at least give yourself and your family the capability really to say, well, what would retirement really look like? And you mentioned purpose. I think that whether it's young people, people in the workforce, or even unfortunately retirees, really having a lack of purpose
Right.
That will really do you in from a health perspective. And
Mental and physical.
yes. And I see that over and over with clients in my business. The ones that are engaged, that find purpose and are doing multiple activities, volunteering, doing things that they really want to do, they're going to be active and they're going to typically have a much better retirement outcome. And, you can have all the money in the world, but if you don't have your health and your mind, the money really doesn't matter very much then.
Jeff, looking ahead, we're seeing, it's an understatement, increased economic uncertainty, ongoing affordability challenges, and major generational wealth transfer dynamics. What do you think advisors need to prepare for over the next 5 to 10 years? And how should they be positioning themselves and their practices to serve clients effectively through this volatility?
So, you mentioned it, there's going to be a transformation. We're already seeing it. And, you look at where the financial advisory profession was 25 years ago to look where it is now. It's really on demand. The expectations are escalated significantly.
Mm.
While at the same time, if you can use things the right way, there's certainly a lot of opportunity. As much as things are automated and can be automated, I believe the more wealth people have, the more complicated their family situations, which usually comes along with wealth, you usually
Hmm.
become, your family situation, life becomes more complicated. But the more they want someone that can be there with them and for them, really that can help, whether it's the next generation or even help them work through what their values are, and the fears and things that go on throughout, retirement and really looking at legacy planning and transitioning. And I think the more that you can be a support source, so it doesn't have to be about, the more you get into picking the next stock or the next fund, the more you're going to find yourself out of business. People want someone that they can call if there's been a credit issue where they've had, they get a letter from one of the credit agencies saying that they were exposed to some sort of credit issue.
Hmm.
They want someone that they can call and say, what does this even mean?
Right.
How do I freeze my credit? How do I do things that they may not understand that are confusing? But if you can help them do those things and just help be a resource, so you're going to find yourself probably pretty busy with new opportunities.
That's a great point. And inherent in all of that, I suspect, is this idea of trust, right? That we're living in a world where there's lots of information, but I think clients and people in general don't know who to trust because the information is conflicting as well. So, as you're saying, if you're building, I mean, the technical stakes the technical skills are table stakes, but if you can build that personal relationship, that human interaction, and create that genuine level of trust with your clients, I think I would argue that's the winning combination to be future proof as we move forward.
And I think, it gives the clients there's a greater likelihood that they're going to introduce you to their family. That's, I think, the biggest risk for a lot of advisors, just being very passive and
Right.
just thinking that they're the matriarch, patriarch, they're just going to just give, the money's going to go to the next generation. The next generation is just going to keep it with the advisor. That is the reverse of the reality. And
100%.
the reason for that is, it's really one where you have to focus on the family as a whole, and you have to try to help solve the younger generation's problems as well. Because they're sitting around worried about things that may not seem like a big deal right now, but if you can try to help them, whether it's, trying to figure out, if they have a question about how to even get like a home equity line as an example, or if they're trying to figure out, how do I even figure out how to file a FAFSA form, for their kids?
Right.
You can try to help them with that process and know that you're there if they need something. They're going to be very likely to come to you when they receive, what's going to be, I believe, the largest wealth transfer that I think anyone has ever seen, just because of the generations kind of flipping.
Hmm.
Really, they're gonna go to people that they trust. And if they're not necessarily just gonna go to the parent's advisor just because they were the parent's advisor.
Correct. One last question for you, Jeff, coming back to young adults. So many of them today are dealing with anxiety and frustration when they compare their financial reality we talked about it, to what they see from influencers and social media, or perhaps even what their parents did, etc. So there's a level of expectations that has been set. How do you help clients, the younger ones, recalibrate their own expectations and define success on their own terms rather than someone else's curated highlight reel?
Well, I think it's a natural, anyone that's somewhat competitive too, it's a natural thing to say, where am I at in relation to my peer group? You know, that's an obvious thing, but it's very difficult because everyone's coming from a different perspective or place. And, I've always said the biggest thing that you can do is do yourself a favor and not look back and say, I wish I would have done this, or I wish I would have saved earlier. Just beat yourself up about things because it doesn't change where you're at right now.
Correct. It's done.
It's done, and you can't expect to be someone else that may have had, potentially better opportunities. If someone inherits a bunch of money, they're gonna be in a better position, but they may not really appreciate it in the long run, which is the other thing I think that people sometimes forget. And I think really it's a matter of just starting small and working forward and just working, in within your means and understanding what you have, not what your neighbor has. And if you can do that, you're not going to stretch and you can kind of build over time. And the more that you save, the more that you make the right decisions early, the much easier it will be throughout your life not to have a bunch of wrong turns.
Yeah, I think that's great advice. And coming back to that marathon analogy, I would say it's run your own race, right? I mean, you're not running somebody else's race. You don't have their level of fitness or their level of training or their level of experience. So, you got to run your own race. And it's true.
That's exactly right, and, I'll be the first to say that, there are people that have more wealth than you could ever think about spending, but it doesn't necessarily mean they're happy. So the other thing I think there needs to be a focus on happiness, because there are too many people chasing things that aren't making them happy just to chase. I think really if you can find something that you have purpose and you can find happiness through it, that's one of the things with the centurions that people live in their hundreds. They always say try to be happy and try to be kind. And if you can do those things, everything else usually has a way of taking care of itself.
Well, and that's always good advice, but especially in these times, I think. Jeff, we're coming to the end of our podcast, so I have a few final rapid fire questions for
Sure.
you that I ask all my guests. So, number one, professionally, what is the most important lesson you've learned over the years?
I think the biggest lesson, and I learned it in the military, really was to own. If you make a mistake, you own it, you admit to it, and you work from there. And you'd be surprised, even if you make a mistake with a client, if you can actually articulate and tell them, you made a mistake, you should have done something maybe differently, they'll react completely different because people are always making excuses. So I think if you can just own up to your mistakes, you'd be surprised how much better the reaction is than just making excuses.
That's so powerful, and I couldn't agree with you more. I think genuine, heartfelt sorry goes a very, very long way. And it goes a long way because I think it is so rare in today's world that there's always everybody's afraid, either from a liability point of view or, a pride or ego or whatever. But I think you're right. We all make mistakes. And if you can genuinely apologize for it, and as you say, like I've done this with clients, and I used to explain it to them that look, we will make mistakes. It's is important. Do we own it? And more importantly, what are we doing to fix it? Right. And I think that if you can articulate that well, I think it's very powerful in the client world. Jeff, number two, what is one practical tip you would offer listeners keen on applying your insights?
So what I would say is the best thing you can do is just take a step back from what you're doing right now. And even if you're an advisor and you work with clients, it always say, you want to do what you give other people advice to do. So, it's really a matter of just taking a step back, looking at what your income is, looking at what your expenses are, how much you're saving, how much debt you have, and then really just look at a plan, simple plan where you come up with for 12 months and where you want to be in 12 months. And then what you want to do is just on a monthly basis, just look and see how you're progressing along. And, if you're not headed in the right direction, you just revisit it and you adjust it. But half the battle is just looking at it. And the more you look and try to improve, it's amazing how it works. Typically, you'll improve.
Great advice. Jeff, this is such a important discussion on financial literacy and running your own race. If listeners want to learn more about you or find your work, where do they go?
Sure. You can go to jeffreypanik.com. My firm's name is Balanced Wealth Partners as well, but I have a lot of resources out there, videos, as well as additional information there. I try to make it educational and try to help people make informed decisions.
Amazing. Jeff, thank you for joining us today on the Uncertainty Edge.
Thanks so much for having me, Sam.
Pleasure.